Hey everyone, it's time for another episode of Mayhem in the Markets, Saturday, January 7th, 2023. Happy New Year. I hope the first trading week of the year has been good to you. Certainly has been eventful. Continuing to chop in a range, looked like we were going to break out on Friday, only to see the last hour show some weakness. We ended up closing the week below the 50-day moving average and pretty much at the top of that range, sort of knocking at the ceiling with a little bit of a head fake. And it was interesting on Friday, there was data the market reacted to rather strongly, particularly the ISM data, but also the slowing wage growth data from NFP at 4.7% year over year versus 5%, or 0.3% month over month, which would annualize to 3.6% year over year. So going in a direction that the Fed wants to see, but certainly not nearly enough yet. The upside on Friday was primarily driven by a lot of call buying in SPX near to the money calls that were expiring the same day. And that's one reason that perhaps at the end of the day, the rally started to really run out of momentum and couldn't close above those key levels as those options were being cashed out aggressively before they expired worthless. Nevertheless, there's a lot to cover. This presentation is brought to you by Traderade.com. We help investors and traders focusing on fundamentals, macro, and technical analysis, covering the market from multiple angles to try to help provide a well-rounded educational experience so that you can take control of your financial future. So let's start off. First, the era of negative yielding debt is over. All the dollar bond investments now offer positive yield. So this was a byproduct of zero interest rate policy, negative interest rate policy, and QE. That era is, at least for the moment, over. And that's changed the dynamics in this environment quite a bit. That is to say that when there was a lot of negative yielding debt, the risk-free rate of return was negative such that it was more tempting to take on more risk, whether it was in debt, equities, real estate, or in some cases, even things like crypto. There were also a fair number of banks that set negative deposit rates. Some in places like Japan still do, and that still encourages more of the same. Either keep your cash under your mattress or put it in a market somewhere, but don't keep it in the bank in a deposit unless you want to pay on it. ISM new orders service sector drop was the biggest in history outside of the COVID crash. This was a pretty big deal, and I think it portends to the notion of not only a economic recession, but an earnings recession, both becoming more likely. So this is something that's worth keeping a close eye on as we continue to get data. Of course, on Friday, part of the data was ISM manufacturing showing that there was a contraction. It was a pretty significant drop, and the market liked that, but it's not going to like it when it sees it pass through to earnings of larger companies. And it certainly doesn't portend to an economy that is going to be one that continues to expand this year should this data continue to flow. So I think it does increase the chance of an earnings recession and an economic recession, two things that I expect to be key themes of this year. Credit card delinquencies are accelerating at the fastest pace since the great financial crisis. It doesn't mean we're imminently doomed. It does mean, however, that consumers are starting to show some signs of struggling, particularly the bottom 60%, two-thirds of which live paycheck to paycheck and used credit cards to be able to shore up buying power as prices got out of control for food, energy, housing, and just about everything else. Now, we're seeing goods fall, but core services inflation continues to be a problem, and that could continue to put upward pressure on consumer credit trends. And this is not a good thing because credit cards are revolving debt. They have variable interest rates, and therefore, when rates are rising, consumers are paying a higher burden just to maintain the interest on that debt that continues to compound. Apple has significantly underperformed the S&P 500 recently. This is a company that for the longest time had been one of the champions of the market, helping to drag it higher, as during its highs it was over 7% of the S&P. Now it's less than 6% last checked, and it's looking pretty fragile on a technical basis. But also, just considering the macro picture for a moment, Apple goods are higher end. Many consumers are struggling, as we saw on the prior chart, so the refresh rate for Apple devices may slow down. Consumers may not buy as many Apple devices as they had prior. Also, Apple had some warning signs. They're slowing the production of their iPhone 14 series, as well as their MacBooks and a couple of their other devices, including the watch. And that's telling us that they don't feel there's going to be ample demand, that they still feel there is some concern. So they're leaning more towards caution. This is a company who typically has consumers lined up out the door anytime they release a product, but this year was the first year in the fourth quarter that they didn't release a new line of MacBooks. So if Apple is concerned and Samsung's earnings are falling as well as their revenue on account of lower demand for consumer devices, consumer electronics, that's a big deal. These are two of the biggest consumer electronics companies in the world saying, hold on, we're not so sure about what the future looks like, and the recent past is a little bit concerning. So it's going to be very interesting to see what Apple's earnings tell us, but I suspect we're going to get some less than optimal news on the demand side for their key products. I think their services are going to do okay, because a lot of people get involved in the Apple ecosystem, whether it's their cloud, their music services, and even being app sellers into the App Store and buyers of apps in the App Store. But I think the demand for Apple products will slow a bit, and people will wait just a little bit longer to buy their next Mac or phone or iPad or watch. Consumer Confidence Labor Survey, little bit of a concern with just how tight this remains. This is close to some of those peaks that, of course, inspired Fed tightening, and actually higher than the peak we saw in 2007 and higher than the peak we saw in the early 90s. So what does that tell us? It tells us we have an exceedingly tight labor market, and that is one of the factors that drives core services inflation, because it portends to wages staying high, at least in nominal terms, and continuing to grow. We'll have to see whether the slower wage growth month over month was a trend. I think it has been slowing month over month for some time, so that's encouraging. But at the same time, is that going to be durable if the labor market remains as tight as it is? So we'll have to see whether Fed policy really begins to manifest itself in real economic terms in a slowdown of what's happening in business activity, in hiring, in consumer spending, such that it lowers demand. And demand is one of the drivers of inflationary pressure, particularly in a supply-constrained world in certain key components of our economy. And so in order to see that demand drop, of course, jobs need to be less plentiful. Right now, there's about 1.7 jobs for every one person looking. And so that means people don't stay unemployed for long. It also means that people that are negotiating a new job can generally negotiate a better salary than they would otherwise. The worst years ever for the U.S. stock market. And would you look at that? 2022 is just right there below the middle, below 2002, the dot-com crash, below the Great Depression. But this era, called the Great Inflation, is still a pretty nasty time for stock market returns. The worst, of course, on the list is the Great Depression. There were several years of the Great Depression listed here. But the Great Financial Crisis is the second worst, and that was a pretty violent year in 2008. Almost everything got obliterated. Then there were some days you'd wake up and look at the market and it would appear like it was almost bidless. There was wider spreads, the futures were trading erratically, and sometimes the Fed would come in and do an emergency rate cut or some other sort of intervention to try to salve the market, which really didn't work very well until we got later into the year and ultimately into 2009. So I would look at this as this was an interesting time. 2022, very nasty year for the history books, because it was one of the rare years where stocks and bonds went down significantly at the same time. And a lot of that has to do with an aggressive Fed because of inflation and inflation itself. So inflation is the bogeyman. It's worse than an aggressive Fed in the sense that if the Fed doesn't do anything about inflation, it can be a big problem for society, for the economy, and for businesses. So the Fed's doing what it has to do. It's probably got a lot more work to do. But for now, we look back at 2022 and say, you know what? We hope we don't see a year like that anytime again soon. But unless and until inflation fades and the Fed gets out of the way and starts easing again, the path of least resistance still may indeed be lower. The January effect is shifted to November since 1990, which means those rallies tend to come later in the prior year rather than early in the current year. So in the beginning of January, typically you get a little bump and then a sell down. Is this year going to be different? The dynamics certainly are different than prior bull markets, which is what the market spends most of its time doing, appreciating in value. This dynamic being different may lead to a different outcome in January. It's certainly too early to tell, but what we do know is buybacks are pretty much fading out as we get into earnings season. A lot of those buybacks have been reduced significantly in the blackout period that the companies have to engage in, because they can't be buying their own shares if they know what their earnings are going to be and how that may impact their shares in the market. The other side of it is, though, after we get out of those beginning of month flows, it's a little bit quieter. And in a liquid market like this, it's not going to take much to move price significantly in either direction. So with big events like CPI coming up, that could be a big game changer. We're going to have to see how the market reacts. December gave us a big head fake, a rally, and then really just closing near the lows of the day. But October was the opposite, where we had a sell down that then became an enormous rally. And so I think we need to pay very close attention to what kind of data we get from the economy and what kind of talk we're getting from the Fed as a result. Obviously, if inflation continues to slow, particularly in the core services side, that could give some cause for optimism. And on the other side of it, if we see signs that inflation is not slowing, that the job market is remaining resilient, that could give some fear to the bulls that the Fed is not going to be getting out of the way anytime soon. Central banks have been net buyers of gold. They can't get enough. This is one of the largest periods of purchasing that I've ever seen. Now, it could be a contrarian indicator. We don't know. But what we do know is it's taking physical supply off the market and turning it into leasable supply. Central banks do like to lease their gold. And sometimes that leased gold can be used as basically collateral for putting on short sales. So we'll have to see whether or not that ends up being the case, whether this is a bullish event, a bearish event, a neutral event. For right now, I don't have much of an opinion other than to say, wow, that's interesting. Looks like they're really adamant about buying gold. I would also imagine part of this has to do with the fact that there is some drop of wanting to park so many reserves in dollars, in euros, in other currencies, and wanting to have something that might be a little more resilient during an era of unprecedented inflation. While the performance of gold hasn't been very encouraging in 2022, certainly if inflation becomes a more entrenched theme along with geopolitical tension and maybe erosion of the dollar as a reserve currency over the decades to come, gold might not be a terrible place to be to have some resilience, to have some diversification of reserves. Wall Street's 2023 forecasts are very optimistic. Obviously, we don't know what this year is going to bring, but if we look at everything over 4,000 here, which is the majority of the list, we'll have to see what happens, but I personally think that might be just a little bit too optimistic for now. I would lean more towards something between 3,500 and 3,900 being our year-end forecast, but of course I could be completely wrong. Anything can happen. And finally, some housing markets have already turned, others are about to. This is a theme I've been talking about for quite a long time, really since late 2021, that the housing market was due for a meaningful correction, that there's been too much leveraged buying, people buying too many homes, investors getting too aggressive, buying too many multifamily units and single homes to rent, and that eventually a lot of that supply is going to become motivated sellers as price turns against them, and in the case of investors, as they flee, either because their clients do or because they themselves have a financial situation that may impair their ability to keep that loan, that mortgage, or whatever is used to purchase the house in their case, and therefore they may become motivated sellers even at lower prices. So the forecast for 2023, they might be a little optimistic, particularly for the US, but we'll just have to see what happens. So I want to thank everyone for tuning into this episode of Mayhem in the Markets. A little joke here at the end. New traders, easy to fumble. Experienced traders, sometimes we take a very elegant path to fumbling. But either way, the biggest takeaway here is have a system, trade by that system. Don't allow your emotions to interfere with your trades. Instead, be much more robotic. Have a set of rules that you're following. Document your trades in a journal. Why, how, what are you getting into, and what size? Are you legging in or going in all at once? Are you getting stopped out? Are you scaling out, or are you, taking it all off at the same time? Talk about how you're feeling during these trades so that you get a better idea of how emotion might impact your returns, and make it so that your system is simple enough that you can consistently execute it. Until next time, this has been Mayhem in the Markets.